We all know the drill. Time is money. But what if your money could work for you, giving you more time to do what you actually enjoy? Sounds too good to be true? It's not. In this video, I am going to show you 5 dividend stocks that you can invest in today to retire with more than double or triple your current salary. I'll walk you through why these stocks are a great choice, how to find them, and in the end, I will show you how you can combine these stocks into a portfolio that will turn a one-time $25,000 investment into a portfolio valuation of over $2 million and pay over $20,000 in monthly dividend income. All right, let's lay some groundwork before we jump into details. If you're new to dividend stocks, think of them like this. They're companies that pay you just for owning their shares. Here's how it works. When you own shares of a dividend-paying company, you get a piece of their profits. These payouts are usually made quarterly, so it's like getting a thank you check just for being a shareholder. But the real magic happens when you reinvest those dividends. Instead of cashing out, you use that money to buy more shares, which in turn earns you even more dividends. It's a simple yet powerful cycle. More on that later. The best part is, dividend-paying companies are often stable, established businesses with a track record of weathering market ups and downs. Now that we've covered why dividend stocks are so effective, let's move on to the big question. How much do you really need to quit working and live off that passive income? All right, let's crunch some numbers. If you've ever dreamed of saying peace out to your 9-to-5, the big question is, how much money do you actually need to make that happen? Well, it depends on your lifestyle. If you're cool with a simple, laid-back life, you'll need less than someone chasing private jets and champagne brunches. For this example, let's aim for a comfortable $5,000 in monthly income, which works out to $60,000 annually. If you were to invest in the S&P 500, which historically offers a dividend yield of about 1.5%, you'd need to invest $4 million to hit that $60,000 annual income target. Yup, $4 million bucks. That's a tough goal to hit unless you've already got a trust fund or a winning lottery ticket lying around. S0. What's the solution? The answer is, focus on high-quality dividend stocks, and you can significantly reduce the amount you need to invest compared to traditional strategies. And if you have time on your side, it gets even better. Later on, I will show you how you can reach 4 times that income with only $25,000. But first, let's see how time can significantly reduce the required investment amount. It's all about the compounding effect. If you're not familiar with compounding, it is basically the snowball effect for your money. It's when your investments start earning returns, and then those returns start earning returns. Over time, this cycle creates exponential growth, and it's a total game changer. Here's how it works with dividends. Imagine you invest $1,000 in a portfolio or dividend stocks with a 5% annual yield. That means you'd earn $50 in dividends in the first year. Instead of spending that $50, you reinvest it into the same portfolio, adding to your investment. Now, at the start of year 2, your total is $1,050. This larger amount earns dividends, so your payout in year 2 is $52.50. Again, you reinvest it, bringing your total to $1,102.50. By year 3, the compounding snowball is gaining momentum. Your dividends are calculated on $1,102.50, giving you $55.13. Reinvest that, and now you're up to $1,157.63. In just 3 years, your initial $1,000 has grown to over $1,157, all without adding another penny. And this is just the beginning. Now let's highlight how compounding speeds up over time. In year 1, you earned $50 in dividends. By year 3, you're earning over $55,000, not because the dividend yield changed, but because your reinvested dividends are now earning their own dividends. The cycle feeds itself, accelerating your growth. The beauty of compounding is that the longer you let it work, the faster your money grows. Over time, the growth accelerates as dividends earn dividends. In the end, I will show you a portfolio that takes full advantage of compounding and has the potential to turn a one-time $25,000 investment into a portfolio valued at over $2 million, while generating over $20,000 in monthly dividend income. Now, to make compounding work, you need to select stable, dividend growth stocks. Not all dividend stocks are created equal, so how do you pick the winners? Here's the game plan. First up, dividend yield. This is the percentage of the stock price you'll earn annually in dividends. A yield of 3 to 5% is usually the sweet spot. Too low, and it might not be worth your time. Too high, and it could be a red flag for financial instability. Next, dividend growth. Look for companies with a history of consistently increasing their payouts. This shows they're not only profitable, but confident about their future. Who doesn't love a raise, right? Then there's the payout ratio. This tells you how much of a company's profits are going to dividends. A ratio under 60% is ideal. It means the company has room to reinvest and grow without cutting payouts. Lastly, think about stability and diversification. You want companies that thrive even in tough times, like utilities, consumer staples, or healthcare. And don't put all your eggs in one basket. Spread your investments across different sectors. The goal? A portfolio that's balanced, sustainable, and built for the long haul. Now that we know what to look for, let's check out the actual stocks that make the cut. First on the list is the Schwab US Dividend Equity ETF, also known as SCHD. This ETF is like the Swiss Army knife of dividend investing. It's a one-stop shop that gives you exposure to a basket of high-quality US companies that consistently pay dividends. With a current yield of 3.60%, average dividend growth of 11.04%, and share price appreciation of 7.39%, SCHD offers a solid foundation for steady income and growth. Plus, it's low-cost and highly diversified, making it an excellent core holding in any portfolio. Next, I have the Home Depot. If you've ever tackled a DIY project or renovated a room, you've probably contributed to this company's bottom line. Home Depot isn't just a home improvement retailer, it's a dividend powerhouse. With a yield of 2.28%, an impressive average dividend growth of 16.95%, and a staggering share price appreciation of 14.18%. This stock is all about consistent performance. It's a great choice for long-term growth and reliable payouts, even if it doesn't offer the highest yield up front. Then there's Hormel Foods Corporation. This is your classic Steady Eddie stock, providing stability in even the toughest markets. Known for brands like Spam and Skippy, Hormel has a strong foothold in the consumer staples sector. With a yield of 3.66%, dividend growth averaging 10.94%, and modest share price appreciation of 1.82%, it's a solid defensive play. While it may not shoot the lights out in terms of growth, its reliable income stream makes it an essential part of the portfolio. Moving on to NetEase, a tech company from China with a knack for delivering strong returns. NetEase combines high growth potential with a reliable dividend payout, making it a unique pick in the tech space. Its current yield is 2.65%, backed by a very strong dividend growth rate of 17.29% and share price appreciation of 16.46%. Last but definitely not least is CubeSmart, a REIT specializing in self-storage facilities. This might not sound glamorous, but self-storage is big business, especially in today's fast-paced world. CubeSmart offers a high yield of 4.82%, average dividend growth of 14.65%, and share price appreciation of 6.58%. It's a great income generator and a solid way to add a real estate component to your portfolio. REITs like CubeSmart are particularly attractive for dividend investors because they're required to distribute 90% of their income back to shareholders. Each stock in this portfolio serves a unique purpose, creating a balanced mix of growth, income, and stability. SCHD is the backbone, offering broad diversification and consistent returns, acting as the portfolio's steady foundation. The Home Depot adds high-powered growth with strong dividend increases and share price appreciation, ensuring both income and long-term expansion. Hormel Foods brings stability, acting as a defensive player that thrives even in volatile markets. NetEase injects dynamic growth with its tech focus, combining reliable dividends with substantial capital gains potential. CubeSmart rounds out the portfolio with high-yield real estate exposure, providing steady cash flow through its REIT status. Together, these stocks form a well-diversified portfolio built for sustainable growth and reliable income. Now that we've got our 5 powerhouse stocks, let's talk about how we're going to put this portfolio together. The plan is simple. Equally, distribute the $25,000 across all 5 stocks. That means $5,000 will be invested into each one. This approach keeps things balanced and ensures you're not overly reliant on any single company or sector. With this allocation, the portfolio will have a current dividend yield of 3.4%, an average dividend growth rate of 14.17%, and a share price appreciation of 9.29%. Now, here's the exciting part. How much can this portfolio grow your $25,000 over time, and how much in dividends can it pay? Let's find out. At the start, you've got your $25,000 split equally across our 5 stocks. In the first year, this investment is projected to grow to $28,172. Fast forward 10 years, and your portfolio will be valued at $89,017. That's more than 3 times your initial investment without adding a single extra dollar. At the 20-year mark, your portfolio will be valued at $397,539. After 30 years, it is projected to reach a valuation of $2,530,468. Around this time, the portfolio will be paying $279,618 in annual dividends, or a monthly dividend income of $23,301. The total value added over 30 years? A massive $2,505,468. That breaks down into $1,154,548 from capital appreciation and $1,350,920 from reinvested dividends. Want to know how to turn a $7 daily investment into a $1 million portfolio that pays the same amount of monthly divine income? Click the video on the screen to find out.